You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody, welcome back to Options Playbook Radio, the program here on the old Options Insider Radio Network, where we break down some interesting options plays, offensive and defensive plays, and tell you how you can incorporate them into your own portfolio. If you're saying to yourself, wait a minute, that's not the usual guy on this program, you're correct. I'm Mark Longo here, and I'm joining Brian on this super duper. It's a special episode. If you can't tell by the number in your podcast player, listeners, it is the 100th episode of this here Options Playbook program. So we thought, what better way to celebrate than by having an extravaganza of epic proportions. So it's going to be really fun. But before I do that, let me introduce your regular host, the options guy himself, Mr. Brian Overby, the senior options strategist over there at Trade King. Brian, welcome back to your own program and happy 100th episode. Spectacular, sir.
Well, thank you, Mark. It's been a very fun ride so far, and I do appreciate the great intro, and I love the fact that we're getting some option experts together to talk about some of the plays that we've done on Options Playbook Radio. We've recently started to get into, after we got through all the basics, we talked about the Greeks, the pricing, we got into each and every strategy that is actually inside the Options Playbook and outlined. And then we started looking at some paper trades, some scenarios that some of the plays might apply to. And a lot of these are around earnings. And I decided to go on out and, put out these paper trades to some other option experts and see what they think about them. And I'm very happy to have Andrew with me today from Option Pit. And I proposed episode 95, which was an iron condor that was done on Wednesday, the 20th of January. And this iron condor, I guess, so I'll set this up for it, and I want to talk a little bit to Andrew about what happened with the condor and what his thoughts were. And I've asked everybody to be candid about this. Let me know the good, the bad, the ugly as far as the trade is concerned. So here's the scenario. Here's what we went through. We had on Amazon, the stock it closed that Wednesday at 571.77. And if you recall, Wednesday the 20th was a very volatile day in the marketplace. Amazon was actually at one point down over 25 points and then closed only down $2.70. Now, the other scenario that we needed to know with this is that Amazon was going to announce earnings the following week. Now, that's not the expiration that we dealt with. We just saw a lot of pumped up vol in Amazon, and that the implied volatility in this expiration, the expiration that expired before the earnings, was right around 51% because of the general volatility of the marketplace. And here's what we ended up doing. So we ended up doing an iron condor, and it is mentioned that that is on page 126 of the options playbook. That's where you'd find the iron condor. And I'm going to go from the high strike down to the low strike. But what we did was we bought the 592.50 strike, sold the 590 strike, and these are call options, and then went out and on the put side sold the 550 strike and bought the 547.50 strike. Okay. Now, it was noted inside the call that the long straddle at that time was trading for $17. Basically, the 572.50 long call, long put, if you purchased them all in one trade, was trading for $17. And we were looking at a range then by, just subtracting that to the downside and to the upside. The expected range of Amazon over that time period was 587, and on the low end, it was 553. Okay. So we're outside of that range, and we were able to do this trade for a net credit of 78 cents, which meant our total risk was $1.72 per iron condor that we put on. All right. So that kind of summarizes where we were at. And part of my thinking was the markets were volatile and Amazon might slow down a little bit before the earnings and kind of get a hold of itself because it was trading a little crazy, and then go into the earnings. And we'll talk a little bit about what happened after that trade, but I'll now toss the ball over to Andrew and hear a little bit of his comments on that trade. Andrew?
Well, thanks for having me on the show, Brian.
Thank you.
The yet another visit to the Options Insider global radio empire.
He keeps expanding, sir.
I know. So there's a couple things on. One is I think overall selling premium expiring before earnings generally is a decent idea. I like looking for because generally you kind of have that quiet time kind of before the earnings come out. So an iron condor, a good way to do that, making sure it expires before. Also, the iron condor like this, you're picking a pretty short duration. So you're going outside one standard deviation. So all of that stuff, I think, is kind of the right way to look at selling option premium. Basically, you want to sell it and you want it to evaporate or the volatility collapse as soon as humanly possible. That's how I look at selling anything. So at least from a setup point of view, those were good. I think kind of the right way to think about it. The on the flip side of that is, on the 20th, I believe, I'm just looking back, I'm trying to think, on January 20th or so, let's see, what was that, the 21st, January 20th, so VIX was almost 30. So what I call that for my trading when we teach at Option Pit, that to me, that's like zone 4, which is sort of the danger Will Rogers. We don't sell any premium in zone 4. We look at long gamma trades overall. So I know it's going to sound funny to people, but we find ways to try to sort of trick the long gamma. So I really am looking for trades that make me money when the underlying moves. So I would say if I'm in like zone 1, 2, 3, and you get this kind of pricing in Amazon prior to earnings, where it closes, I'd say, yeah, that's a good idea. I'm in zone 4, I sell nothing. That's the easy answer.
Okay, interesting way to approach it. So basically, I was excited from the volatility aspect, from the volatility of the market as a whole. And when you said that you want to be long gamma, in other words, you're looking to buy strategies when the VIX is over 30 that are basically gamma positive, that you're looking for gamma to explode on. What would be that type of trade that you would look at, Andrew? If you were looking, as opposed to doing something like an iron condor, what would you be looking to do?
Right.
What would
so
be
what
one
we
example?
do is, so an example for that is, so generally for me, anything over 23 VIX, so we're moving at 1.5% per day on average, or more. So I would look, the basic stuff is what we call kind of a fly with a kicker, where I, let's say, buy a call or a put if I have a directional bias. And then I hedge with a butterfly that's out of the money to 1 standard deviation. So if you get a move down, right, the delta flips from, let's say if I'm going to buy a call and then I buy a fly. And what I'll do is I will also, sometimes I will trick the duration, meaning if I'm worried about the market, I want the fly to be nearer term. So if I get the downside move that's hard, my fly will kick. It will make me money. I close it and I pay for the fly and the call that I bought, right? Now I have the upside for a credit, and I just let Mr. VIX at 23 go down and up and down and up, and I have a chance for the trade to be a real home run. So that's one type of position. I got a bunch, but that's the idea of, again, depending on the type of instrument, is it the index? Is it an equity? Is it an ETF? What's the term structure look like? So we try to find trades that are going to give us the risk reward profile to sort of fit the high realized vol. And that's the idea.
And the one big thing I see there, Andrew, that you mentioned is, the gamma of a butterfly. A lot of people don't even think about that, but with a few days remaining to expiration, a butterfly can basically explode as expiration approaches if it's within the sweet spot. And so That's basically your hedge. You're looking at something that's long, that's getting killed by time decay and maybe a volatility crunch, quote unquote. But then you also have another trade that goes along with it that is positive, that wants that volatility crunch, and also is positive time decay. So that's a very interesting way to approach it. Did I sum that up fairly well?
Pretty good. And I generally try to aim the direction of the fly where I think the volatility is going. So, if normally with a trade setup like that, I'll buy a put and a call fly. So if the market goes to 0, I want the put to expand infinitely, right? If we do get that rally back, I want the call fly, the vol to compress, and then the value of the call fly explodes. So that's kind of, I set up something like that when the market, and I don't want to just go out by a strangle necessarily, because like you said, there's, that's decaying like a madman. So you got to be careful.
All right. Very interesting approach. Now, what did happen with this iron condor is that it eventually got a little scary. The very next day, and one thing that I was amazed, so some of my thoughts about the iron condor and why I thought it was an interesting paper trade. And, once again, on Options Playbook Radio, we're always just trying to learn. We're not really trying to put these trades out there as recommendations. But the fact that we could get 78 cents, more than, the expected move out of the money for a $2.50 wide iron condor. And that was kind of surprising to me. I expected that premium to be trading for like 30 cents or maybe 25 cents. And I kind of like the concept that I could get that trade off and hopefully get at least half that premium on the next day to expiration. Basically, I didn't want to be in the trade all the way to that expiration date. And I guess that talks a little bit to your point on gamma, Andrew, and that if this thing got anywhere close to the money, and I outlined that on that episode 95, I think I got that right. Yep, episode 95. That if that thing got anywhere close to the short strike, we were just going to get out of that trade. And we're going to take our lumps or maybe even make a profit, depending on what happened to vol and what happened to time decay. But what so happened on that trade is the next day, Amazon just basically, the range that I have, just looking at the chart here over at Trade King, was it opened at 573. Now, remember, it was at 571 the day before. And the high, it did make a run. It ran up to 5 588 and the low was 568. So there was quite a range, and it closed at 575, almost where it opened at. So at the end of the day, the trade was up about half of the premium. And kind of your thoughts on that. If that was the case, how would you have approached this trade based off of that information, or what might have happened to you during the day, the very next day, which was the Thursday before that Friday expiration?
Well, again, once you trade 588, that's probably a little touchy for how, depending on the size you did. So I have two ways to approach those trades there. One is I put on a size because I think the way you structured it, the risk reward was really nice. You get 78 cents, you're risking $1.70. So you figure, okay, let's say I sell a 5 lot. So the most I'm risking $750. So then at kind of that size of trade, I just sort of leave it. Meaning I think there's edge in the vol, and I'm just going to sell stuff. If you're like selling a 10 or 15 lot, now all of a sudden you got $2,400 in risk. You're like, well, again, depending on your portfolio or whatever, that's big. So you'd probably be buying some calls at some point, meaning if you took in on a 10 lot, that's $780 in premium. The problem with Amazon, it's kind of hard to buy a hedgeable. So normally, let's say if you buy one call and you sell a spread, it sort of hedges the trade. So at that point, I would either saying, okay, I'm going to just lose X dollars. Normally what I'd say is I'm down 25% of the premium. I'm just going to close. I'll just take out the side that's not working. I'll try to work out of the put spread and be done. So those are your choices. In Amazon, when you sell iron condors, as I put on a couple of positions in there, there's no real way to hedge short spreads with long contracts because of the the pricing. You got to spend $8 for a call and you get $500 for your spreads. It would just be, you get close. To me, it's about 25% of the credit, and then I'm out. I'm just closing the spread, just assuming that I thought the vol would come in and Amazon wasn't going to move another $20, but surprise, it does. So out I go.
All right. That was perfect. That's exactly the way that I would have looked at this trade too, is that you're so close and there's so much premium that it's really a win or lose scenario. So in other words, you have your goals and your highlights as to where I'm going to get out, either via where the stock price is at or how much percentage premium you're willing to lose. And yeah, you're right. Buying a long call or buying a long put because it's moving against me is pretty tough to do in this scenario, because a lot of times you'll end up losing more on the long call or on the hedge as opposed to you did just by closing out the trade. And it doesn't give you a ton of opportunity in those scenarios. And that's the downside of doing an iron condor in quote unquote gamma week, that last week to expiration. So I did want to say, Andrew, this was an awesome call. I do really appreciate your candor. I love the way that you looked at the market and some of those ideas as to how to approach when the actual VIX is above 30. Never really thought about some of those things that way, and that you're going to try to hedge long options by using butterflies. And what's also interesting with this is that we're going to talk a little bit later on with one of your colleagues, Sebastian, a little bit about Amazon and a butterfly that actually happened at earnings. So those are some of the trades that we're going to look at. So I really appreciate you coming and helping us kick off this options playbook extravaganza of the 100 episode.
Well, I hope the extravaganza continues. Thanks a lot, Brian.
All right. Thanks a lot, Andrew. All right. So that's it for this episode of Options Playbook Radio. We'll be back same time, same place next week. We're going to talk to another options expert about one of the many episodes of Options Playbook Radio. Thanks for listening, everyone. And please share all this information with your friends, family, via Facebook, Twitter, any way that you can.
Now, let's open the playbook and get started.
All right, everybody, that music means it's time for Options Playbook Radio, the program here on the Options Insider Radio Network, where we break down all of those amazing options plays, offensive and defensive plays, and tell you how you can incorporate them into your own portfolio. If you're saying to yourself, hey, wait a minute, he's not the usual host of that program, you're right. My name is Mark Longo. I host a lot of shows around here, but usually not this one. Usually it's another guy who I'll get to in a second. But of course, the reason I'm subbing in today is because it is such a special episode. It is our 100th episode, spectacular, so spectacular indeed that we had to break it up into multiple episodes. This is part 2 of our 100th episode, spectacular. And joining me, as always, for this spectacular of options fun is your regular host, the options guy over there at Trade King, Mr. Brian Overby. Brian, welcome back to your own program, and happy 100th episode to you, sir.
Well, thank you so much, Mark. I really appreciate you hosting this event and the fact that we've got to 100 episodes and that it's been so well received by the listeners over at Options Insider Radio that I wanted to go on out and talk about some of the paper trades that we've looked at on Options Playbook Radio. And I really don't think it's enough to just say that whenever I look at a trade that there's only one opinion in my way or the highway. So I thought it'd be fun to bring in some experts that are also in the industry, some good friends of mine that are sometimes on Options Insider Radio, sometimes on the Trade King platform, and ask their opinion of specific episodes that we've gone through and that we've looked at. And we recently did a trade in Twitter on Iron Condors. Now, Iron Condors in the options playbook is page 126. And I decided to ask a good friend of mine, Dan Sheridan from Sheridan Options Mentoring, to look at this trade with me. And I'm going to introduce him here in just a second. But if there's a man that knows Iron Condors, I know that man is named Dan Sheridan. I've heard him teach Iron Condors left, right, and sideways. So with that being said, I'm going to jump right into the trade. And then I want to ask Dan a few questions and look at his opinion on the trade. Now, all of these trades were done basically around earnings, which, makes it kind of tricky, but it also makes it interesting because after the earnings event, something happens. And that's usually the case when you're looking at different stocks. So this stock was Twitter. Most people know it out there. Symbol was TWTR. And we actually looked at this trade right before the earnings announcement. So we looked at it on a Wednesday when it got taped. And it was kind of interesting because Options Playbook Radio wasn't published until the following day. So the earning announcement had already happened and the trade was already rocking and rolling. So an Iron Condor, as I said, is on page 126 of the Options Playbook. So I'm assuming that you kind of understand that if you're listening to the call right now. And I'm going to give you the strikes. We'll start from the highest strike down to the lowest strike, and we'll look at the risk and the potential reward of the trade. So the highest strike call that we bought on the call side is we bought the 21 strike call that went out and had expired on February 19th. Okay, that's the call that we looked at. Now, this trade was being put together on the 10th of February. That's meant that this was a 9-day option contracts, and they all had the same expiration, which is common with an Iron Condor. So the first call we bought was the 21 strike call. We then sold the 19 strike call. Then we went down to the put side and we sold the 11 strike put. And then our hedge was to buy the 9 strike put. Now, Twitter at that point in time was trading at $15.58. So we were right at the money, basically, or almost right at the 15 strike line. We looked at the long straddle, and that was mentioned in the call. And the long straddle at the midpoint was trading for 3 points. We had an implied volatility of 172% on that front month option. That's where that implied volatility was at. So it was a really crazy time for Twitter. And these were the strikes that we were looking at. Now I'm going to make a couple other points, though, before we get too far along. But the whole trade was done for, at the midpoint, a net credit of 41 cents. And on a 2.1 wide spread, that meant that there was $1.59 of risk. And that risk was going to be intimate because they were announcing earnings. Right after that trade, after we looked at those trades and looked at those pricing, earnings actually came out on Twitter. Now, part of my thought was Twitter's been beaten up. I mean, the high at one point in time, I'd say I think it was within the last year, was well over 50. And now it's already down to 15. It got beat up a little bit more. The stock was very volatile overall. And I was kind of guessing that maybe this was a little bit overdone. And to look at that long straddle, now remember, we used the 19th expiration that went out 10 days. They had a different expiration that expired in 2 days. That implied volatility on that expiration was around 313%, rounding off in that scenario. So with all that being said, my thought just in general was that the vol was a little bit juiced, to say the least. And I actually even got quoted in the Wall Street Journal that week about talking about, one of the largest expected moves that Twitter has ever seen on a percentage basis. I mean, 3 points was about 25% of the underlying is what the underlying stock was looking to move. Okay, so went out 10 days, and I'll talk a little bit about that, but I kind of want to get Dan's idea on this little trade, on this little thing, that scenario that came up, and ask, would you ever do a trade like this around earnings? Do you like iron condors? And if you don't, be candid about it. Let us know. So I'd like to introduce now Dan Sheridan from Sheridan Options Mentoring. Hello, Dan.
Oh, hi, Brian. Thanks, Mark, and thanks, Brian, for having me. And I think this is an interesting trade in Twitter. First thing I could, talking about this trade, I don't have a problem with the trade. I don't have a problem. I think the thinking was right on. There's not a lot to disagree with, as far as why you put this trade on. I think the big thing, in my opinion, for viewers would be, the first thing is they hear this iron condor, right? They hear this term iron condor. And I want to be clear that this to me is a spec trade. I normally would do an iron condor in SPX or RUD or a stock when it doesn't have earnings or something. And I'm putting it on every month, 4 monthly income. Here, it's like I grew up on the west side of Chicago. On the west side of Chicago, they sell baseball bats. And so when you think of iron condors, you think of this range-bound, nice, warm, cozy strategy. And to me, we're using a baseball bat to beat somebody here, in my opinion. We're using an iron condor in a totally spec situation, right? So it's a much different, it's like a totally different strategy to me because you can't adjust it. You know what I mean? I mean, once Brian puts this trade on, I'm assuming if I lose, I could lose I could lose my margin of $159, right? So when I do this trade, when I do a normal SPX iron condor every month, if it goes against me, I can adjust it. It's the stock or the SPX goes up, goes down, I can adjust it. Here, once Twitter closes, what did earnings come out on a Wednesday, Brian?
Yes, right after we taped this event, the earnings actually came out.
All right, so if I put an iron condor on Wednesday, the last chance to put it on would have been Wednesday towards the close of trading. I can't trade this sucker until Thursday morning when it opens. And it could open $5 higher, $5 lower, whatever. I can't adjust it till it opens. So the way I look at these trades is, if I'm willing to risk let's say I'm willing to risk $1,000 on this type of a spec trade, that would determine my size. So my margin's $159, right? So I'd take 1,000 into $159. And what's that, about 6 contracts, somewhere around there? So I would do 6 contracts here. But in terms of and that's how I would look at it. I would look at it that if I lose, I'm taking the stance that I could lose everything, and that's going to control my size. Totally different considerations if I'm doing a normal, let's say, April SPX iron condor right now, right? Totally different way of looking at it. But in terms of the trade itself, all the thinking is exactly how I look at it, speculative earnings plays. And again, I look at it, I think it's important, Brian, pointing out, you didn't come into this thinking you're going to do an iron condor. People think, okay, I'm going to do an iron condor. No, I do iron condors and earnings type stocks like Apple. Apple's a good stock that, usually the market maker move that you talk about, usually it moves less than the market maker move, and an iron condor would be a correct strategy in those situations. But I think your analysis was, hey, this is the expected move. You were counting on it moving maybe less than the expected move. So then after you did your homework, then you decided an iron condor was something that could, fit your opinion. But you didn't come into here thinking, I'm doing an iron condor, right?
You're reading my mind exactly, Dan. I really did not look at that. I was looking for volatility. I was actually thinking about backspreads, thinking about something else. And there was a lot that came on with that stock that week. So I find it interesting that you're saying that, because that was actually the stock that we talked about in our midday market call at Tuesday on the Trade King site. So yeah, I really wasn't thinking that going into Twitter. So yeah, right. Keep going. I'm liking what I'm hearing.
Yeah, I mean, the only thing I don't, here's the only thing, just so Brian and I, you can't say that we're like, we'll never disagree. The only thing that I look at here, a lot of people do iron condors for earnings for the wrong reasons, right? In other words, they'll say the volatility's high, so I'm going to sell this high volatility. The volatility will come down, and that's how I'll make my money. I think that's wrong thinking. Of course, the volatility's high, every earnings period, right? For a lot of these stocks, not all of them. And so to me, I wouldn't do an iron condor. Number one reason, because the volatility is high in Twitter. I'm doing an iron condor because I think that the Twitter move is going to move less than the market maker move, or less than the expectations. And therefore, an iron condor fits my opinion, right? I'm not just selling it because the volatility is high. The volatility is going to come down. There's no doubt. But the stock could be up $7 and then I get $7 or $8. So I'm only selling an iron condor. Sure, I guess secondary, the volatility is high, and that's a reason. But the reason I'm doing an iron condor is because I think the actual move is going to be less than expectations. It could be high volatility. If I think the move is going to be more than the market maker move, I could do the unthinkable, right? I could buy a long straddle, buy one at the money, call and put. So I think the strategy is kind of driven by only at the last point when, hey, it comes down to, do I think the move is going to beat expectations or not, right? And I think some people say, they get caught up in, I'm selling it because the volatility is high. That's not the main reason I'm doing it, right? I'm not, the reason the volatility is high is because there's an event called earnings, and the stock has a history of moving plus 10%, more than 10% every earnings. That's why the vols are high. And so anyways, I just think it's, that was more just for the public listening, how you should approach these earnings type situations. But I think for people looking, I think Apple's a good one. Apple, if you look at the last, Brian, I don't know if it's the last 12 quarters or 13, if you would have done a 10 delta iron condor on the weekly, you'd make money at like 12 quarters in a row, because it's... All
right. I heard some Dan Sheridan mentoring lingo there. What do you mean by a 10 delta?
Oh, yeah. So a 10 delta would be, so if you look at Apple the day before, or Twitter, like Brian did here the day before earnings, I'm looking to pick my short strikes of the iron condor by the delta. So if I sell a 10 delta in the call and in the put, that means there's only a 10% probability we're going to finish beyond that strike by the expiration. And if it's a weekly, that's just a few days. So basically, if you're selling a 10 delta call and put, it's got about an 80% probability of expiring worthless. So again, 10 delta means there's only a 10% probability we're going to finish beyond that strike. So a 10 delta iron condor, I've classified it years ago, is called a high probability iron condor. So I'm selling a 10 delta call, 10 delta put, and it means the probability of all the options expiring worthless are about 80%. And so that type of an iron condor works well in Apple. And I don't know the deltas that Brian picked for the 19 strike in the calls, 11 strike in the puts. But my guess is, with the stock at 16, it was pretty close to a 10 delta, would be my guess.
All right, Dan, that awesome explanation. Thanks for taking the time to say exactly what that meant. Now, yeah, they were. They had to be, especially what really amazed me about this trade was that we got it done for a 41 cent credit to be that far out. But then again, I told you the implied volatilities were 313% in the very front month and 172% in the expiration that we were trading. And I just was amazed that we could get that much credit on a 2-point wide spread. The risk reward was fairly decent for what that trade was, basically that to be able to get 41 cents with $1.59 worth of risk. And we went out one more expiration. And part of the reason why the thinking there was that I wanted to be able to close that position. If it started to go against me, I was hoping the juice might stay a little bit in it and just be able to get out. But I would have never let this thing, if it gapped open below the short put or the short call, there's not much you could do. But I would have been prepared to trade out of this paper trade. I would have been prepared to trade out of it if it got anywhere close to those strikes anywhere before expiration. And the strikes were 19 and 11. And remember, the stock was trading right at 15.
Hey, Brian, 2 questions. What did you look at what this Iron Condor was trading in the weekly?
No, I didn't. Actually,
okay.
I didn't.
My bet is it was pretty close to 41.
I have a time and sale. I mean, there were only 2 days remaining to expiration. I probably did. But the one thing is to think about, and I just got done talking about this with Andrew from Options Pit, is to think about gamma in this scenario. If you're selling something like this and it's this close to expiration and it's right around earnings, you got a ton of gamma that could hit you if it did gap open. There really just wouldn't be much you could do at all. If you give yourself a week in a very volatile stock like this, you usually got an option. You got something that you might do. And I mean, you were saying in this scenario, would you ever, here's one question for you, Dan. Would you ever try to hedge this position, or are you literally just putting it on and hope that ball comes out, hope that time decay and taking it off? And if you lose, you lose. I mean, what do you ever try to hedge in a scenario like this?
I don't.
As opposed to just taking the trade off?
I don't. I'm putting it on for a reason, right? Again, this is a totally like the baseball bat analogy. I'm using the baseball bat different than the intended purpose. I'm using the Iron Condor in a speculative purpose in a speculative trade for earnings. So when I put it on, I generally try to take it off when the event happens. So I'm trying to take it off. If I'm using the weekly, that expires in a few days, I'm generally taking it off that day. When earnings comes out, like you said, earnings came out after the close on a Wednesday, I'm taking it off Thursday morning or Thursday afternoon. Now in this case, you have 9 days, but still, you may have to wait a little longer, but again, it's a small credit, 41, so they may hold a little bit into it. But my guess is, it's probably trading. What was it trading when this opened? Around 7 cents, maybe. I mean, it'd be hard to get out of it.
Dan, are you sure you didn't go back and look at time and tape before you came on this call?
No, I honestly didn't. I'm just winging it here.
I know, because what basically happened was the stock the next day, and we got to wrap it up here and move on for Options Playbook Radio. But yeah, what happened the next day was that it actually moved more before their earnings report the few days before than it did on the actual earnings. So the next day it opened up 58 cents, which wasn't nothing to sneeze at, which was about 4%, which is a good move on a $15 stock, but it was nowhere close to the 25%. And according to time and tape, it was trading for 5 cents on the open the next day. And the only thing that I can say about that is if you did not get out at that moment. Oh, I'm sorry. That was actually the close price. My time and tape is showing me close price, but that was 5 cents on the close the next day. But if you did not buy that back and buy your shorts in, at least, you're just crazy on any one of these trades. As a matter of fact, you should have even been out before that. If you could have bought it back for 10 cents, I'd say you want to get out of that trade. Just trying to get that last nickel or dime out on anything that you sold is usually not worth that risk.
Hey, Brian, one quick negative, just not against you, but just for viewers that maybe are listening here. I don't normally do iron condors for earnings for this little credit. I may get more. There's nothing wrong with this. But if somebody was doing, let's say, a one contract, and the problem at some brokerage firms, if you do a one contract, they might hit you with a hefty ticket charge, right? And so if you're only bringing in $41 credit and you're doing it, let's say, one time, and you have a ticket charge of $15, $20, right? That's half your profit. So I think the only negative I could see here would be for a retail trader that was only doing it one or two times, that didn't have a good commission rate, or some brokerages, when you're doing one or two contracts, they hit you with that nice hefty ticket charge. So you're not getting enough credit to offset that, in my opinion. That would be the only possible negative I could think of.
So I guess you would have to be able to do it more, or have part of your spec portfolio to have, be able to do more contracts to make it more worth your while, which that's fair. Good thing at Trade King, we don't have to worry about that as much, but so that was a nice setup for that. But in general, we're one of the lower end on the option pricing. But yeah, I understand that. If the commissions are always very important, and you got to figure them into your trades. You can't just look at a profit and loss graph and look at that. You got to add those commissions into the trades, and you also got to think about bid-ask spreads. Those are two things that are important. All right, Dan. Well, that's it for this episode of Options Playbook Radio. I love these discussions that we're having for the 100th episode, which is going to run into the 102nd, 103rd. I just invited a lot of friends from the options industry to basically critique the trades that we've talked about on Options Playbook Radio. And if there was one man that to talk about iron condors, not necessarily even around earnings, but just in general, I know Dan is a big seller of iron condors in his teachings over there at Sheridan Options Mentoring. So I really do appreciate you coming in and give us your insight, Dan. Thanks for coming.
Thanks, Brian. Appreciate you having me, and thanks, Mark.
All right, everyone. Okay, that's it for this episode of Options Playbook Radio. Please let your friends know more about this program. It's free for all. We do appreciate it. Go to our Facebook page if you have any questions or suggestions, facebook.com/TradeKing. And you can send direct questions directly to me via that Facebook page. You can see archived sessions of Options Playbook Radio. And as always, you can auto-download these via iTunes or Stitcher. Thanks for coming, everyone. And we'll be back same time, same place next week with another additional episode celebrating the 100th episode of Options Playbook Radio.
Now, let's open the playbook and get started.
All right, everybody. Welcome back to Options Playbook Radio, the program here on the old Options Insider Radio Network, where we break down all of those amazing options plays, those offensive and defensive plays that you too can utilize in your own portfolio. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the aforementioned Options Insider Radio Network. And if you're saying to yourself, wait a minute, that's not the usual host of this program, you're right. I'm just subbing in for today to kind of do a little intro here because it is such a special, a momentous occasion. It is indeed the 100th episode spectacular of Options Playbook Radio. It's such a special moment. We couldn't squeeze it all into one episode, listeners. No. This is a multi-part 100th episode extravaganza. You are currently listening to part number 3 here, actually, as we break down this multi-part extravaganza. It's really fun. I'm looking forward to it. I'm certainly having a good time. And joining me on the old 100th episode spectacular is your usual host, the options guy over there at Trade King, Mr. Brian Overby. Brian, welcome back to your own program, and happy third part of your 100th episode spectacular.
All right. Yeah. I kind of feel like it's my girlfriend's birthday week. It just keeps going. She no longer has a birthday day. It's a birthday week. So I'm kind of running with that theme. This is the 100th episode week. as far as Options Playbook Radio is concerned. And we're going to end up doing quite a few episodes. So we've decided to go on out, and I've made a few friends in the options industry by doing this for about 20 years or so. And I have another one on the show with me today, Russell Rhoads, who works over at the Options Institute, which is the educational arm of the Chicago Board Option Exchange. And it's a place where I used to work. I worked there for many years, one of the favorite places that I've ever worked. And Russell is, I'd say he's one of the foremost experts about trading volatility in general. He's literally written a book on it. He's written books about trading VIX options, trading weekly options, trading spreads. And I just learned today that he's actually got a new book that's coming out that's going to talk about a lot of the other new products that have came around regarding the VIX options. And I'm excited about this because every time I start a show, as far as a trading strategy, I always look at what the VIX is doing. I don't quite necessarily know why, but for some reason it gives me some comfort to know where the implied volatility is of the marketplace as a whole. And before I open up the mic to Russell Rhoads and some of the questions that I have for him, because I'm excited to go through this interview also, I just want to tell you a little bit about where the VIX comes from. And what the VIX is in general is the implied volatility of the S&P 500 index, one of the most quoted indexes out there, 30-day options. And what they've gone is they've determined that they're going to make a fictitious option that's never going to be a 29-day option and never be a 31-day option. And it just kind of gives you a feel for the general volatility of a very important index that is out there. And amazingly so, the Chicago Board Option Exchange eventually, after many, many years of it getting quoted left and right on CNBC and all the other big television financial shows left and right, they found out a way to actually trade some option contracts on it. And once that got figured out, oh my gosh, the floodgates were opened. And there's many different products that have came in that you can trade options on, that you can actually buy outright, just like you could buy a stock. And all of this started from this little formula that helped us get a feel for volatility in one of the biggest indexes that is out there. So with that said, I'd like to introduce Russell Rhoads from the Options Institute over at the Cboe. Hello, Russell.
Hey, how's it going, Brian?
All right. So far, so good. It's been a great trip so far on our over 100 episodes now. We should be at about 103 or so. So with that being said, as far as the products that are available, Russell, what products do you prefer to trade in or watch? And what is interesting out there as far as the VIX has came around? And do you know any history? Like how long has the VIX been around, and how long have people been derivatives been available on the actual VIX index?
Well, VIX was created by Dr. Robert Whaley, who's a super nice guy and a professor down at Vanderbilt, I believe in 93. And we introduced the futures in 2004, and nobody really seemed to care. I say we, I wasn't here at the time, but nobody really, they traded a little bit, but then the options were introduced in 2006. And, nobody can argue that VIX futures and options are probably, over the last 10 years, the most successful new listed derivative product in the world. The growth has been absolutely phenomenal. And then in 2009, what I refer to as the exchange-traded products. And I use that term because some are exchange-traded notes and some are exchange-traded funds. And that way, I don't have to keep track of which one's which. I can just call it an exchange-traded product. But things that trade just like the SPY exchange-traded fund that are based on a VIX strategy were introduced with VXX that I think everybody's familiar with, love it or hate it. A lot of people loved it when it was up 40% after the first 4 or 5 weeks in 2016. And then, like all ETFs or ETNs, we've got, inverse inverse funds and leveraged funds. There are a couple of inverse funds that a lot of people like to pay attention to, especially because, as a pro, we know that over the long term, being short volatility makes money. There's just a lot of getting run over by a steamroller along that path. SVXY is the one that I like to pay the most attention to. I also get a lot of questions about XIV. The reason that I like SVXY is because there are weekly options available on it. And then the leveraged funds that a lot of people like to pay attention to that give you 2 times the daily performance to the upside of VXX, TVIX, which was in and out of the news because they had some issuer problems a few years ago, and then UVXY. And then once again, I like UVXY, again, just because it has weekly options on it. VXX, UVXY, and SVXY are the only 3 exchange-traded products that have weekly options. Now, we have weekly VIX options as well, but I think those exchange-traded products are very interesting for individual investors. But you've got to have a good handle on how they trade as well, and you need to know what you're getting when you get involved in those funds. And when you own VXX, you're actually getting exposure to the front 2-month VIX futures, and you're also getting exposure to a portfolio that's rolling positions in those futures every day. And for instance, today, February 24th, the March future closed at 21.75 and the April future closed at 22.10. And the rolling transactions for VXX involved selling some March futures at 21.75 and buying some April futures at 22.10. And that rolling action actually causes a persistent headwind for VXX.
Okay, so what are some of the other headfalls? Like when they got a roll, that sounds expensive to have to do those type of trades. Where are they doing these trades, and how does that affect the actual valuation of something like the VXX?
Well, the trades are being done. There's actually a trade settlement process here at Cboe where the funds that are based on VIX futures, such as all those exchange traded products I mentioned, will do rolling transactions that are priced off the close each day. And more often than not, the front month VIX future is at a discount to the second month VIX future. Now, we're actually, as we're speaking, we're coming out of a period where for the first 30 days in 2016, the front month future was at a premium to the second month future, which is unusual, especially for that long a period of time. But we've had years where we've only had 1 or 2 days where the front month is at a premium to the second month. So just about every trading day, or more often than not, this negative roll yield, and that's what they actually call it in the prospectus. They call it a roll yield, but it's a negative roll yield, has a negative impact on VXX. And my buddy Mark Sebastian, I'm just stealing this number from him and I haven't verified it, has said that the negative roll yield on average costs VXX about 4% a month.
So that's basically what they have to make up each and every month. If you were to buy the VXX just outright, is that something
and if you're
that we can say, or how does the math work with that, Russell?
Well, if we're in normal contango, yeah, they're going to have to overcome that, and you'll actually have days where VIX is up and maybe both the futures are up slightly, but the fund actually loses some value, and it's because of that negative roll yield. Now, that negative roll yield is actually a positive more often than not for SVXY, and that's one of the reasons that traders get attracted to SVXY, especially after periods of extended low volatility. And I think we had back-to-back years, maybe 2012 and 2013, where the inverse ETNs were actually up over 100% on the year. But the issue with that up 100% is when we get some sort of volatility event like we have in early 2016 or like we did in August 2015, those funds can lose 20 or 30% in a week. And that's not unheard of.
So that brings up another question that just comes off the top of my head. If you're trading these type of vehicles, are you usually looking to trade them on a daily, a weekly, or a monthly basis, or even a yearly basis? I mean, what do you see a lot of customers doing that are coming to the Cboe and getting into these products?
I kind of like to look at them as short-term trading vehicles. In fact, you often hear the phrase that comes out from Cboe, volatility is an asset class, and I like when I hear volatility is a tradable asset, and that's why I like the three funds that have weeklies, because if we get a big spike in volatility tends to revert to some sort of a mean. I like when I see out of the money or slightly out of the money call spreads sold on VXX when the fund's up 20 or 30%, because it's got that structural roll yield that works against it more often than not. But you also have volatility, which tends to revert around a mean as well. So, shorter term trades, especially with these funds and using options on these funds, I think are the most attractive way to go.
All right. And do you think that most people are using them for speculation? Is there a way that some of the, let's say, even bigger hedge funds will sometimes use these products to just flat out hedge market movements, let alone volatility movements?
There is that market aspect to everything. And, you were, as I often say, when you and I have been out doing classes together, you used to be one of us here at the Options Institute. And, when we're working with beginner traders, we all, and they want to know what's the best option to buy right off the bat. And you say, well, you've got to start out with an outlook for the underlying. Well, with respect to volatility or any of these volatility derivatives, I always say you've got to start out with an outlook for the overall stock market, and then start to translate into what do you think that's going to do to volatility, and then what's it going to do to the derivatives based on volatility. So, that same sort of outlook can cause people that maybe traditionally used SPX options to hedge against a downside move in the overall market to actually consider some of the volatility derivatives as well, and with the purpose of the trade actually being based on what they expect in the underlying market.
All right, excellent. So a couple of other notes that came up that I wanted to ask you about, and just in general, should we worry if it's an ETF on volatility or an ETN? Is there any real big difference, any one that is better than the other, or are there just trade-offs? And do you know any of those things? What's involved with it?
Well, okay, I nobody's allowed to listen to half of what I'm getting ready to say. It's very important.
That's what we love on Options.
It's very important that this full point gets across here. An ETN is actually a bond obligation of whatever entity issues that ETN. I mean, you and I could act, well, this is kind of a stretch, but you and I both like baseball, and we could actually issue an ETN that pays off in dollars how many games the Cubs win next year. And
well, I know you're a Sox fan, Russell. So.
I know. Well, I'm trying to be a good guy here. But the point is that, and then we got to figure out some way to try to match that performance ourselves. So the ETNs, the VXX is an ETN, and it's actually a bond obligation that is matching an index that's based on that strategy that I mentioned, the front 2-month VIX futures and the constant rolling. SVXY and UVXY are actually ETFs, and it was just a decision that the issuers of those two funds made. They just decided to stick with an ETF structure because it's what they knew, actually. I asked them why they chose that, and that's what they chose. Now, they actually have positions that are backing the exposure of UVXY and SVXY. They've got short exposure in VIX futures, and they've got long exposure for that UVXY fund in VIX futures as well. VXX has they hedge themselves with VIX futures, but they don't have to necessarily have the same, they don't have to be holding those futures, but they do have to be there and be ready to make good on the obligation that goes along with the performance of that strategy. Now, this is where I really do not want to, I like my job and I don't want to make anybody mad and I don't want to be misunderstood here, but let's say we end up in a financial crisis situation again, and the issuer of VXX is the firm that goes out of business. Now, I don't think that's going to happen. I'm not predicting that happens. But if it does happen, in a financial crisis, you expect volatility to work for you. Well, if that's the entity that goes out of business, instead of getting the benefit of the spike in volatility, you're going to be in line with everybody else trying to collect as a bondholder. I don't think that's going to happen. My understanding is in 2008, there were a handful of very illiquid ETNs that were backed by Lehman Brothers that some people got left holding the bag. Not any very major funds, but some very small funds that people got kind of stuck with.
All right. So with all that being said, and I do really appreciate your candor, Russell, and we all know what happened to Lehman Brothers when it was all said and done. But, on Options Playbook Radio, we've never had the opportunity where we've gone out and just looked at a paper trade on a specific underlying or whatever. And going forward, I think I want to do a few of these trades, kind of talk a little bit about the VIX. I've in my own personal trading, I've traded some options in it, more than once, and had good luck and had bad luck. Is there one particular underlying that we should maybe look for a paper trade in going forward? Something that I can talk about on Options Playbook Radio with our listeners. Is there one out there that interests you, Russell?
I think the beginner trade right now would be something in VXX. And what I tend to like to do is if you think that, volatility is a little bit ahead of itself, maybe selling a slightly out of the money call spread. Since today's Wednesday, I would want to look a little farther out than this Friday. So maybe out to the next Friday, selling the 26 call, buying the 27 or the 28, just to get a feel how those options behave. But something like that, and really,
I love that you haven't said the word as the expiration and all that. I do like that because,
I think that's a good way to go.
Yeah, we're going right there with that paper trade, and that nothing's meant to be a recommendation. Obviously, when we talk about options, it's all about learning, and that's what we're going to try to do. We're going to try to look at some volatility trades, and we got a volatile marketplace. So I thought it would be great to have you come on, just because when the VIX was trading down 11, 12, it was very boring to actually trade these underlyings. Not to mention the S&P 500 index. I used to do a butterfly strategy in that week in and week out, and with vols so low, it was just even hard to accomplish it. I don't like the VIX when it is trading at 10, 11, 12. I don't like just the general market option trading. I like the VIX when it's up around 15 and where it's been recently in the 20s. But in general, we'll go on out. We'll look at that on the VXX. I think we'll do one episode based around that and kind of look at when you see vols high, going a little bit of an out of the money call spread a week or so out.
That's I think that's one of the best ways if you want to start dipping your toe into trading volatility. Whenever we get a spike, just take a look at the next strike up in the VXX, something that's expiring, 5 to 10 days down the road, and see what makes sense as far as how much farther out you want to go when you buy the call option for protection. But definitely buy the call option for protection, because VXX. I was at a trade show earlier this week, and I was showing a couple of trades in VXX recently, and I've reconstructed VXX performance from back in 2008 using the index, and there was a 4-week period where it was up 120%. So
wow.
Do not sell out of the money calls. Put on some sort of protection, because it can move.
Right. It is a spread index, not an individual.
Right.
Almost. I don't know of many people that trade any type of volatility products and don't spread the option contracts just in general, even if they're trying to get on the buy side with a debit spread or on the sell side with a credit spread. A lot of times very rarely, there's just so much juice just in general in these underlyings that most people like to sell spreads or buy spreads. All right. Well, Russell, I want to say thank you so much for coming and being part of this 100th episode of Options Playbook Radio Extravaganza. And I'll give you one last little word here before we sign off on Options Playbook Radio. When do you think, is there a time period, like within a month or so? I don't want to pin you down, that your new book might be coming out on volatility in general.
We're going to say by the end of March.
Okay. All right.
That's what we're not going to hold. I'm about halfway done, and I'm going to
that you're coming out with it. That's a very, very short time frame.
No, I'm pretty close to getting it done. I just gotta get over the hump, and unfortunately, this time of year is a tough time of year as far as the travel goes for those of us at the Options Institute. So that's kind of what's getting in the way right now.
All right. All right, Russell. Well, thanks for coming. That's it for this episode of Options Playbook Radio. If you would like to give us some feedback on the 100th episode and any episodes before that, you can always email me directly at theoptionsguy@tradeking.com. You can also send me messages via our Facebook page, which is facebook.com/tradeking. We have a special page made for Options Playbook Radio. And as always, let your friends and family know about this episode. And I want to thank Russell and the others for coming and say, please check us out next week, same time, same place. Thanks for listening, y'all.
Now, let's open the playbook and get started.
All right, everybody. Welcome back to Options Playbook Radio, the program here on the old Options Insider Radio Network, where we break down some interesting options plays, some offensive plays, maybe a little bit of income, and maybe some defensive plays to protect your portfolio. And we tell them how you can incorporate them into your own trading accounts and into your own portfolios. My name is Mark Longo from theoptionsinsider.com, as well as a little thing we like to call the old Options Insider Radio Network. You may be saying to yourself, wait a minute, he's not the usual guy on this show. You are correct. You win the gold star. But this is a special occasion, listeners. This is indeed the 100th episode spectacular here of Options Playbook Radio. An episode so special, so spectacular, we couldn't fit it all into one episode. So we had to break it up into many, many parts. This is actually part 4 of our 100th episode spectacular. So thanks for tagging along with us and joining us on this very special venture. And I'm just coming in to say congratulations. Your real host, your usual host on the old Options Playbook Radio is the options guy himself, Mr. Brian Overby from Trade King. Brian, welcome back to your own program, and congratulations on this epic 100th episode spectacular. Well done, sir.
All right. Thank you so much, Mark. I do appreciate it. And this has been a lot of fun. So what we've done, if you've been listening to the last few episodes, is we've gone out and solicited advice from other options experts. And it's been a lot of fun. We went back and looked at some of the recent episodes that we've had on Options Playbook Radio, where we actually talked about some paper trades and learned. And as always on Options Playbook Radio, they're just learning events when we're talking about specific trades. But we've covered a lot of trades and all the plays inside the options playbook. So we're going to continue going forward, looking at different scenarios, which I might find interesting to actually do a paper trade on and learn about these advanced or even non-advanced option strategies. And so today we have another expert with us. You might know him as Uncle Mike, but Mike Tosaw from RCM Wealth Advisors. He's basically a financial advisor over there. And he's been on Options Insider Radio on many other different programs. He was good enough to come on in and look at episode number 93 of Options Playbook Radio. We actually went out and did a backspread with puts on Netflix, knowing that earnings was right around the corner. So let me take a little time to recap the show. You can always go back and listen to episode 93 if you'd like. But basically, here's what the concept was. We had been on our midday market call, myself and Michael Kahn, Barron's columnists usually do every Tuesday on the Trade King webinar platform. And we had been talking about a little bearish trade a little bit in Netflix. And when I looked into it, I saw that Netflix was about ready to go on out and announce earnings. It wasn't that far around the corner. So we got a little bit of a bearish forecast. We got some volatile option contracts. And so going into earnings, I really don't want to be in a trade where I have a lot of risk relative to Netflix moving way too much. And Netflix is just a really crazy underlying. So I looked at trying to do a backspread, which would reward me if the market moved more than the expected move. And in this instance, on Netflix, we had looked at the long straddle, which we always do when we're looking into Netflix at that time, around that earnings and when that day is going to come out. And when we looked at that underlying, we were looking for about a 16-point move, basically on Netflix based off of the long straddle that was on it. So what we did was we went out and looked at a backspread that was looking for at least an 11-point move. And by that, what I'm saying is we had the width of the spread at about 11 points. So let me give you the trade. And the concept of a backspread is that we're going to sell an in-the-money put option to try to help pay for two at the money or just out of the money put options. And a lot of people will sometimes call this a ratio spread because we're selling one to help buy two. And this was done, episode 93 was taped on the 6th of January and it got posted on the 7th of January. But it was after the close. So we're using prices as of the 6th of January after the close. Netflix had a fairly decent move up that day. It was at 117.68, which I think just kind of fed into this a little bit in that already had a big move up. So even a little bit more rationale as to maybe why we might get a little bit of a pull down in the market. And what we did was we sold one of the January 22nd expiration. And that's what both of the option contracts, they were the January 22nd expiration. And in these expirations, we had, if you did the math here, we were on the 6th. We're looking at the 22nd. So we had quite a few days away until that expiration date. And we knew that earnings were coming out on the 19th. Okay. So the stock had been volatile. The markets had been volatile. And we sold the 128 strike put to try to help buy two of the 117 strike puts, which is basically where the market was fairly close to. And as with most ratios, you want to try to get it done for a net credit to the account. I would have had to go out another point in order to do that, but I was able to get this done for a 50-cent debit to the account. And when we're doing that trade, what you're really looking for is you need to get at least what the marketplace is expecting for a move over that time period. And if it does, well, on the downside, you're long one more option than you are short, and specifically a put option. So you have substantial upside potential. And Netflix is such a crazy stock. It's always good to have that upside potential if the underlying market's going down. And then if the marketplace starts going up and it goes up, moves that expected move to the upside, which is against us, we needed to go at least above the 128 mark by the expiration, that put that we sold, in order to limit that risk to that net debit that was paid for that original trade. So if I look at this trade and I look at the width of the spread and what was paid for it, it's a little bit of a nutty trade because the maximum risk is whatever we pay for that trade minus that width of the spread. So it's a fairly expensive trade to do, but one of the biggest advantages of it, that maximum risk only happens basically at expiration if that stock stays right at the 117 strike. In other words, it's got to expire right there. And if it's anywhere close to that as expiration approaches, I mean, if you ever lose the max risk in a ratio spread or a back spread or whatever we want to call this trade, if you ever lose that max risk, you deserve the stupid award for allowing that to happen. Because if it's anywhere close to that strike as expiration approaches, you just basically got to get out of that trade. All right. So that was a little bit of thinking on the trade. This was a little bit of a nuttier trade. That's part of the reason why I wanted to make it as part of the 100th episode of Options Playbook Radio, and wanted to bring someone else in and talk a little bit about what their thoughts are on something kind of crazy from Options Playbook Radio. And so with that being said, I'd like to open the mic to Mike Tosaw from RCM Wealth Investors. Hello, Uncle Mike. How are you doing?
Doing well, Brian. Good to be here. And are you still based out of Florida?
No, we're not. We're now actually based out of Charlotte, North Carolina. But yeah, when we started Trade King over 10 years ago now, we just had our 10th anniversary. We were based in Florida, Fort Lauderdale area.
God, I just remember when you guys first started. I ran into you at some booths back in when I was at Options Express in the old Money Show days. But I digress. But anyway, in regard to this trade, a couple things that came to mind on here. The first thing that comes to mind is that whenever looking at a trade like this, I think you need to be very fluid, meaning that you don't have to hold this trade after expiration. So, for example, if you got into this trade when Netflix was at 118.10, let's say that's exactly where you got into it when that happened. Netflix actually got down as low as 101.21 on the 14th. And so at that stage, you got your movement right there. Now, you could have made an adjustment. You could have taken some type of a profit, but guaranteed you're mathematically impossible not to have had some type of profit on that day before the event even happened. So the first thing that I think you need to really be mindful of when doing a trade like this is that you don't necessarily have to wait through the earnings to actually do it. Now, in terms of a back spread itself, I think a lot of people who are newer to trading sometimes get confused with this. I prefer doing a back spread just as a trading veteran, but the synthetic that helps me to often explain a trade like this, or a nutty one, as you put it, Brian, is that, and what a synthetic is it means it's the same risk reward, just with a different set of options, basically, is it's this, doing this trade would be the exact same as just an old fashioned straddle, in this case, the 117 straddle, while selling the 128 call against the straddle. It would be the exact same risk reward theoretically. And so sometimes when people see a trade like this, they think, oh, it's just a 50-cent debit. I'm only risking 50 cents. Not the case. You're risking, as you put it, Brian, the difference between the strike prices plus the debit. So what I recommend people do when you don't really understand the gist of a trade, look at what the synthetic would be. Synthetics are very common. A covered call is the synthetic for a cash secured put. Long stock plus long put equals long call. There's a lot of ways with which to learn about that. So with that, the other thing that I want to mention on this is that this is a trade with which volatility plays a big factor. Normally, if there is no major event, you're going to get eaten alive by time decay between the time of the 6th and the 22nd because of the fact that you have a couple of weeks until expiration. However, in this case, there's a major event that's coming. In this case, it was on the 19th with the earnings. Because of that major event, there's a lot of uncertainty. Because of the allotment of uncertainty with which exists in the upcoming earnings announcements, there's a lot of fear in the market, meaning that there's a lot of people that need to buy options to protect their position, or there's a lot of people that want to buy options because of the fact they want to capitalize on what they believe will be a big movement in the underlying. So because of the earnings event, normally I'm not a fan of buying options front month like this, but I like this because of the fact that you have the implied volatility kind of neutralizing the time decay going into the event itself. Now on this, I think the other thing that you have to be mindful of is that as you're looking at a risk reward graph, oftentimes people look at a trade, whether it's a back spread, a call spread, a put spread, a condor, a butterfly, whatever, and they just look at what the expiration risk reward would be, meaning that, oh, I'll need the stock to go down $11.50 for me to break even. Well, yeah, that would be true if you did hold it till expiration, but you might not need that much movement in order for the trade to become profitable if you get out before expiration. So the other thing that I would encourage people to do is really have a knowledge and understanding that on a trade like this, it's not necessarily it's not what the expiration risk reward graph is. Expiration risk reward graphs are great for explaining the concept of a trade, but in something like this, when you're trying to trade this around a fluid event that happens before expiration, really have an understanding of all factors of option pricing and not just what would be there with expiration. Now, the other thing that I like about this is that it has a bias to the downside with the puts. So oftentimes with the implied volatility having an inverse relationship to movement of the underlying, when the stock goes up, vol goes down, stock goes down, vol goes up. That's kind of a very commonly held belief of what happens with the relationship between Delta and Vega. But my point is that after the earnings announcement, in theory, volatility will likely go down. You never know, but volatility likely goes down because the thing that was causing a lot of the volatility is over. In this case, you're using puts. And so when you have the downward movement before the event, volatility is likely increasing. Now, I didn't get a chance to look at historical vol movement of Netflix during that time frame, and I apologize for that. But very likely, you had an increase in implied volatility. And that's good because of the fact that you have more long options than short options, and it's just an added benefit. I'm not a fan of doing a call-based back spread for something like this, but for a put-based back spread to where the market just shoots up, you're not going to get bit that badly. But if the market goes down, you can profit pretty handsomely. And so that's the benefit of this.
Yes, and that's, Mike, let me jump on in just for a sec. One of the things that you really pointed out and that you came to on your own conclusion is that we had some time before expiration. And one of the things, we had a downward bias just from talking about Netflix on our other show. And that's right. If they're going down, especially into an earnings, you got two whammies here that maybe you can get this move before their earnings, and maybe you can even get out of that type of trade, because if that vol, because we're starting pretty much at the money, and if we can start going down, you're long two puts versus short one, and that one that you're short is in the money option contract. So, there's still some juice in it, but it's not quite the juice of the ones that you're buying. And that was kind of the thought here a little bit. So I love that you came to that and that you were okay with this trade. And it is interesting to see that on the call side, you might not be up for the trade as much. And I think that when you're trading options, a lot of beginning traders don't think about what's going to happen to volatility if your forecast is correct. And I think that's the biggest thing that you got to take away when you're starting to get into these more advanced strategies. You're always battling. It's great to get in a scenario where if your forecast is correct, the right thing should happen to volatility as far as your trade is concerned. And I mean, I think that's the one thing that I picked up the most from what you were just saying.
Yeah, definitely. And so on here, I would do this trade if I had you have to have a slightly bearish bias on this to do a trade, or at least a slightly bearish bias. And if I were bullish, like typically I'm not much of an earnings trader person. I'll tell you a couple stories of some of my past earnings trades that I've done with some client money in the past. But or in a little bit in a second here. But on this trade, if I happen to be bullish on Netflix, I probably wouldn't mess with a straddle type trade. I would probably just say, you know what, I'm bullish. I'm just going to buy a good old-fashioned bull call spread. If it goes down, I'm wrong. But if it goes higher, I don't have the vol kicking my butt so much on the long premium I would have bought on the put side.
All right. So as far as this trade was concerned, Netflix did end up going down shortly thereafter, and vols did actually start to increase on this trade. So within a few days, the market was primed to actually get out of the trade. And you always got to take advantage of that. If you can do a trade around earnings, and you can have a decent profit or somewhere close to your goal, it's always better to just go and get out of that trade before the actual event. I mean, if you can get rid of the risk of an earnings event, that's always a very strong thing or a very wise thing to do. One other thing that I did want to mention too is that, like we said, the risk here was 11 points on that trade plus that net debit, but let's just call it right around 11 points. But honestly, that never even came into play if you looked at a profit and loss calculator on it until basically the last 2 or 3 days on a high priced underlying like Netflix with that type of volatility that was in it. So it was a fairly safe trade to do up until the point of earnings. There wasn't a lot of overall risk that was involved. And what ended up happening, and as a learning curve here, is the underlying market did go down in it, and it was just primed to get out of the trade. So you could have got out at any point in time up until the earnings at a profit based off of the moves over the next couple of days. All right. Anything else to add on this, Mike?
Yeah, and that's the benefit of something like this. If you are active on this, like on the Trade King platform, you can set an order to where you know that once you get to the point with which you're going to get to your profit target, if you go to a party and say, I made an earnings trade on Netflix, and they'll say, oh, well, did you get out right after earnings? No, I got out before earnings for a profit. I guarantee you no one is going to say, oh, you're such an idiot for doing that, you loser. Take the money.
I think the only time the word idiot would come in here is that if you actually did a ratio spread like this and got the maximum loss and didn't get out before expiration, because that's really the only point where that max loss happens. So I would. All right. With that said, Mike, I absolutely love your candor on this trade and that you're interested in it. And, going forward, we're going to start looking at more trades around earnings and some of them without earnings. The one thing that's nice about earnings is that what happens. You know that the market's going to move. And that's what kind of makes it fun and make it such a learning experience here on Options Playbook Radio. And I really want to thank you for coming on in and being part of the 100th Option Playbook Radio extravaganza. And that's it for this episode of Options Playbook Radio. If you got a question you'd like to ask or have any feedback on the 100th episode extravaganza that we're having, please let us know by sending an email directly to me via theoptionsguy@tradeking.com, or you can connect with me via our Facebook page, facebook.com/tradeking. We have a special page for Options Playbook Radio that you can actually send messages directly to my inbox and see archived episodes. And we also have put together a 100-day promotion that is available on the Facebook page. So you're going to have to seek that out or send me an email, and I'll send you more information about the 100-day extravaganza to go along with the 100th episode of Options Playbook Radio. So thanks for coming, everyone, and we'll talk to you same time, same place next week.
Now, let's open the playbook and get started.
All right, everybody. Welcome back to Options Playbook Radio, the program here on the old Options Insider Radio Network, where we break down all of the amazing options plays that you guys can use in your own portfolio. Some offensive plays for some appreciation, some income, some defensive plays to protect your portfolio, and all sorts of stuff going on in between. My name is Mark Longo from the OptionsInsider.com, as well as from the aforementioned Options Insider Radio Network. If you're saying to yourself, wait a minute, that's the wrong guy, he's not the host of this show, you're right. I'm just jumping in because it is a very special episode, listeners. It is indeed the 100th episode extravaganza, spectacular, call it what you will, here on Options Playbook Radio. It's a celebration so vast, so immense, we couldn't squeeze it into one episode. So this is actually part 5 here of our 100th episode spectacular. It's been a fun run so far, and we're looking forward to a lot more fun here. And now let me turn it over to your actual host, the options guy himself, Mr. Brian Overby, the senior option strategist over there at TradeKing. Brian, welcome back to your own 100th episode spectacular, and congratulations on 100 episodes.
Well, thank you so much, Mark. Yes, and I love this little thing that we've done. I almost want to, do this going forward. We've asked some other options specialists to join us and go back and look at the last 100 episodes and look at some of the fun trades that we did. And a lot of them we've done around earnings, and get a perspective from someone else that's a quote-unquote expert in the options arena and see what their thoughts were. And we've had some candid discussions already going through this 100th episode extravaganza, which is, obviously we're more than 100 at this point in time, but the trades and some of the perspectives that other people have, especially when we're getting into some of the more advanced strategies that are laid out inside the options playbook, like the skip strike butterfly. So today we're actually going to focus on a skip strike butterfly on Amazon around earnings. This was episode 96, and we've asked Mark Sebastian to come on in from Options Pit and look at the trade and give some of his thoughts on the trade and be very candid about it, what he liked, what he disliked, would he do the trade, would he not do the trade, and then we'll go through and we'll actually see what happened in the trade, and we'll talk a little bit about it and throw in a little insight. So before we get too far along, well, let's get directly into the trade and let's talk about the setup. You can obviously always go back to episode 96 and listen to it from the very beginning, but basically with Amazon, it was a very volatile day. I mean, we're talking about in January. The show was taped on January 27th after the close, and we're looking for this trade to be done by the 29th, which was basically just a 2-day trade right after earnings, after that entire trade gets done. So when we looked at Amazon, the concept was we're going to be bullish on Amazon. And Amazon's a 500, at that day it was 583.35. So it's an expensive stock, and the implied volatility for that first week expiration was up around 128%. So we had a expensive underlying with a lot of volatility. And with that being said, we start out just like whenever you're doing an earnings trade, we started out by looking at what the most at the money long straddle would be trading for to try to get a decent feel for what the marketplace is expecting as a move. I like to kind of say it as the over-under after the earnings report. And we did a little rounding off on it, but it was determined that the 585 long straddle, long put, long call, if you were to purchase it, would be right around $50. All right. So we use that information to try to go on out and pick some strikes and try to set up our skip strike butterfly. And what we ended up doing, and if you have a pen handy, you can feel free to write this down. We ended up buying the 610 call and then selling 2 of the 630 calls. So that's our middle strike. And then going out and skipping the 650 strike call and then buying the 670 strike call. Now, all of these option contracts were real expensive on their own, but the thing that was interesting about this trade is we were able to get this whole gaggle of securities off for a net debit of 12 cents to the account. All right, now, that wasn't the maximum risk, and we emphasize that. The concept of a skip strike is that we're actually embedding a credit spread into the butterfly to help pay for the butterfly. And that credit spread is from the 650, the strike that we usually would buy on a normal butterfly, to 670. That's the credit spread. And the concept is that you got another 20 points, or basically 2,000 more additional risk on that trade if the underlying market skyrocketed all the way up to 670. Now, remember, I said the expected move on this was right around 50. So we were talking about, let's just round up from 585 plus 50, we're looking at 635 is where that strike would be. And that's why we sold that 630 strike. So you're saying that this underlying had to go from there all the way up from 630, another 40 points to 670, almost double what the expected move was, but for us to get that maximum risk on that trade. And now the other side is, what if you're dead wrong and the market didn't move at all? Well, on the downside, the net debit paid is our maximum risk, which is about 12 cents here at that midpoint. So if we're dead wrong, we're going to lose that 12 cents. If we're dead right and it went out right at expiration, right at that middle strike, well, the upside is that you could make that 2,000. But if you ever did on a skip strike, I think I even mentioned this in the show, you basically should receive the idiot reward for doing it, because you should have been out of the trade a lot longer, as long as you had a decent profit and you would have had to set your goal and got out of that trade before that expiration date. All right. So that was a mouthful. That was an episode in itself. So now I think it's time to turn the reins over to Mark Sebastian from Option Pits and get some of his candor on this type of trade. And first of all, what do you think about doing just trades around earnings? And do you have a favorite trade after we get through this? I'd like to know, like, which way might you have approached it if you didn't end up doing a butterfly or a skip strike, Mark?
Yeah, I personally don't trade a lot of earnings. I'm generally kind of a volatility trader, and about the only area where I feel like volatility is kind of completely unpredictable is around earnings. And my friend Russell Rhoads has done some different research, and he's about to put out some really interesting notes about the performance around earnings. And if you listen to our Volatility View show, you probably heard it, that if you sell straddles around earnings, you lose. And if you buy straddles around earnings, you lose. And the net difference is the bid-ask spread. Now, that being said, I do think that there's some smart ways to trade around earnings. And when I do play earnings, it is entirely in the form of the broken wing butterfly, often otherwise known as the skip strike butterfly. Now, I trade them a little differently. Generally speaking, especially if I'm putting on something where I've got disjointed risk in the direction that I want something to move. So, for instance, in your Amazon trade, you theoretically actually want Amazon to move up. And so when I execute these trades, one, I never set up the long wing, which you would set up at 610, inside the straddle. I always set them up at a minimum at the very outside edge of the straddle. Two, I won't do them unless I'm paid for it. So you end up – so in this case, I'm looking back at the trade that you did. I probably would have set this up around the 630 strike that was your short strike. That probably would have been the strike I go for as a long. And what I might have set up would have been owning the 630s for about $8. That's about where they closed, maybe 8.25. And then as I look, I might have sold the 640s at, just for simplicity's sake, let's say $5.75. So that would be what, $11.50 minus $8, a $3.50 credit. or a $3.50 credit, and then I would have gone out and bought your 660s for $3, creating a net debit of a net credit of 50 cents on my spread, and set something up where really Amazon has to make a completely outsized move for me to get myself in trouble. I'm getting paid if I'm wrong. The spread's a little tighter. So, it's 10 by 10 by 20. So I'm risking an extra 1,000 instead, or really 950, because I'm taking a credit instead of the extra 1,000. But, it's a little less of a home run that I'm going for, but that's more consistent around where I'll go. Mm-hmm. And so when I do set these up now, in terms of how I actually use these, I usually look for I use these a lot. This is a very pro trade in the form of indexes. When I was a floor trader, primarily the trade that we would execute is the 1x2, where you're long 1, short 2 outside of it. And this is just kind of the retail version of that trade because it has margin control. So recently a trade that I did that was very similar to this split strike was in a name like USO. The USO, we saw OVX, which is the VIX of oil, get up over 80. Well, that's a perfect time to sell it, to execute one of these trades for a credit, because you're selling a lot of Vega. Even if you do it for a debit, it's a huge short Vega trade. And that is how I usually set these up. I wrote one up for thestreet.com where I do some writing, and it was, I believe I did like the April 1, 8-7, I think I did the 875 broken wing, and I did it for a small credit or even money. So two sides of the same coin, I would say, Brian. You and I both love these trades. This is probably my favorite trade. And just kind of different approaches to how we view them. But my general trade, especially names like Amazon or Netflix, is to get a little further away from where the straddle price is predicting the move.
That is very interesting. First of all, it should be said that I had no idea this was your favorite trade going into this call today. You know what? I think most of the time when I will do these, I would look to try to get this done for even. And I don't necessarily remember exactly what time of day we were doing this on, but I would have normally liked to get this at least even, because if I'm dead wrong on my forecast, I'd like to, just lose commissions on the trade. So that's a very good point.
I
never really thought about just going way out of the money on it. Now, if you do that, and I did obviously you've done a lot of them. I think I picked the right man to talk about this Amazon skip strike. Is there a benefit to skipping the strike? I would like to know, you made it less wide. You went 10 points wide.
Yeah.
Sometimes you skip the strike and you're just, you're buying a 5-cent option as opposed to a 10-cent option.
Right. Yeah. I mean, the key is getting paid. And so you want to do, all of your strikes should have some meat to it. And, when you're doing this, especially on calls, because generally call implied volatility, if you look at the skew or kurtosis, when you set these up bullish, you're buying a less and less, progressively less expensive option. And, when you're not, it can, that's a sign that, maybe this isn't something that you should be doing these. And for instance, both these trades work out really well, but, you end up in a really favorable position kind of across the board on Friday, the way this thing trades around. So, I think the big benefit is to do it for a credit. Generally speaking, I won't buy an option that costs 5 cents. I won't buy an option that costs 10 cents unless I'm closing it.
Makes sense.
I'm a big believer in the ABC approach, right? Always be closing. And so if I'm setting a broken wing fly, the skip strike, all the strikes have to have some meatiness to them. They have to have some value. But the real benefit of doing the broken wing is I'm trying to get paid. I want to get paid to be wrong. And I want to put myself in a position where if and when volatility does collapse, I'm able to really take advantage of it.
All right. Well, that's some awesome insight on that aspect. And what was really interesting about this trade was just all the juice. And this is when skip strikes get interesting, is when you got an underlying that's $583. I mean, to be honest with you, I really was disappointed after the Apple split. I love that Apple used to be a $700 stock, at one point in time. And that's because it gives you some of this meatiness, and you don't have to do a 10 lot and still have some benefit of doing that trade. And one of these underlyings, when you get something like this, and with Amazon being down, it was down, 18 points on that day that we were taping Options Playbook Radio, that not only did we have the volatility of the earnings report that was pending, but we also had the volatility of the marketplace that was just going crazy, not only on the stock, but even in the VIX. And so it should be said that any type of butterfly that you're doing, you always more volatility when you put it on makes the butterfly cheaper just in general.
I use these to express directional opinions in indexes all the time, like SPX and Russell as well, especially, after they sold off. I like using it to form a bullish position for a credit. And then once vol comes in, I can use some of that credit to buy calls. And on the other side, when we've had a big sell-off, I'll actually set up way out of the money little bull plays for credits, where if the S&P does get a 50 or 80 or 100 point bounce, I'm able to potentially flip something I put on for a credit at a credit, which is my favorite thing to do.
Oh yeah, that's a great suggestion. So balls come up. That's when butterflies and indexes look good, especially skip strikes, something that you can get done for a net credit. So a lot of good takeaway from this here. And one of the other things too is, the expiration date. We went out on Options Playbook Radio. I'd like to get your insight on, would you have done this around earnings? Would you have done the 2-day one, or would you went out another week and looked at a 10-day or looked at a 14-day or something like that?
If I'm going to go out at a week or two, I'm probably looking more at straddles or long premium. I love doing these in short dated because of the vol collapse. The times where I'll do these in, they're much better for longer dated stuff in indexes when volatility gets really, really, really big. Like right now in oil, I can go out to July and sell 60 vol. This is a great way of 60 implied volatility, folks. That's what I mean by when I say that. So there are, this is an excellent way to express that opinion of being short volatility without having to take a crazy short straddle, short strangle type of view in a name like oil, where it could drop a little bit. And so I love setting these up as a way for volatility to come in and potentially oil to come in at the same time or sit here. And I'll tell you, the ones that I did in USO last week are performing excellently.
That's awesome. That's awesome to hear. Just in general, overall, interesting trade, you would say, nonetheless, right? Obviously, I picked one of your favorites without even really trying.
Hey, you did great.
All right. Well, I think that basically sums it up for this episode of Options Playbook Radio. I want to really thank Mark and all of the options specialists that came in and helped make the 100th episode very special. And Mark, let me ask you one thing before you go. I know you're over there at Options Pit. Is there any way that anybody could get a hold of you if they had any more questions about skip strikes or anything else that's going on in the options world?
Sure. Go to our website, optionpit.com, or you can shoot me an email, mark@optionpit.com, and I'll be happy to answer any questions you might have. We write a daily blog on volatility. Yesterday was on VVIX. Today it's on bond volatility. So if you're interested in the volatility space, come check us out.
All right. Excellent. All right. Well, that's it for this episode of Options Playbook Radio. Thanks for coming, everyone. And if you'd like to get a hold of me, please email me directly at theoptionsguy@tradeking.com. And as always, you can check out our Facebook page. We have a special page for Options Playbook Radio, facebook.com/tradeking. And you can send questions directly from that page that come right into my inbox. And I just want to thank everybody for making the 100th episode as special as all the episodes that have came in on Options Playbook Radio. And thank you so much for being a listener of the event. And hopefully we'll see you same time, same place on Options Playbook Radio.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.